152 points. The Russell 2000 up 34, and the SPX up 36. We're seeing all-time highs. You're seeing the bonds get completely destroyed on the downside. TLT's down 2.5. You have some mixed action in the commodity market, specifically nat gas up 7 cents, USO oil down 4 cents, and you have the dollar up 16 cents, UUP. Also materials up $1.17, looking at XLB trading at 53, and finance is up 75 cents. So what I wanted to do today is talk about how we could position now with this huge run up. I mean, it has been absolutely impressive. How we could actually start looking at the market and saying, you know what, while I'm not really interested in adding to positions or putting on new bullish positions, especially when I just see huge pops like we'd have today, it gets more difficult to put positions on. Where can I start thinking about putting some money to work conservatively that'll give me time to be right, and it's taking advantage of the fact that maybe we've run a little too far, a little too fast, and we haven't seen anything material that is catalyzing this other than hope and promise, right? So I wanted to talk about the diagonal put spread. Now, earlier this week, we talked about the diagonal call spread. We actually put one on for Goldman Sachs as an example. So today I wanted to look at a broad-based index, and specifically I wanted to take a look at IWM. This is the Russell 2000 ETF. Now it's trading at 140.56, and it's up 273 or almost 2%, 1.98% today. Huge move today. But one thing that's notable about this index and this index ETF is it has been lagging as far as the velocity of this move to the upside. As a matter of fact, as we showed this morning, for most of 2017, it's been range bound between 137 and 140. Now this breakout today, been extremely impressive. Up $2, 2% pop. It's now joining the party, with its large cap brethren. With that being said, I wanted to take a look at an opportunity where, let's say we get a pullback in the next 20 days. In other words, we go from 140 to 137, basically about a 2.69% pullback over the next 20 days. That would get us right down and challenging that 50-day moving average right here in that 137 level, okay? And that's where I would see that support would kick in, and that's potentially where, if on a pullback, interested buyers, either adding to a position or people that have been waiting to get in this market, that's going to be an area where they could potentially pick up. But in the meantime, after such an impressive run to the upside, how do we take advantage of this? So one way that you can do it is do it in a diagonal put spread. All right. And what do I mean by a diagonal? That means that you're going to be doing an option transaction on the put side in a further out month. You're going to buy that put, and then you're going to pay for part of that put by selling an out of the money put with a shorter expiration cycle. So let me show you the mechanics of this. Taking a look right now at the IWM chains, I'm going to scroll down, and I'm going to look at buying the 142 puts. Now the 142 puts right now are trading roughly a little over $6. They have about a 50 delta, and its implied volatility is relatively low. As a matter of fact, it's very low. So I click there once. I'm going to buy that. Now I want to offset this purchase price, and typically I do these debit spreads. I buy an in the money option, and I'm going to sell another option. In this case, because I'm diagonalizing it, I'm going to sell a little bit further out of the money, but I'm going to use the April expiration cycle because that's about 51 days until expiration. So I double click in there, and I'm going to sell those for $2.15. All right. And let me just increase this font for you a little bit. Currently right now, I could probably, let me scroll down. So I am buying the 142 puts that expire in June. That basically gives me about 101 days until expiration to be right. Currently, the IWM is trading, as you saw over here, it's trading right around 140 and some change, okay? So this is basically $2 in the money. The $137 puts that I'm selling, they're expiring in 51 days. Now, to put some context about what the June and April options, the April options that are expiring in 50 days are pricing in the potential that the IWM could be up or down by about, I think the options are saying right around $7. So there's sufficient price movement being priced in over the next, right around $2.55 plus or minus. And for June, you're seeing right around, and again, let's not guess. Let's look at what the estimated move being priced in. So if I'm looking at the 140 strike, that's, remember, how we do this very quick with the 50% probability, take the at-the-money calls and puts, add those offers together. So that's basically right around, we'll say, about almost $7, right? 324 plus 368, that's going to get you pretty close to $7. Then you have 283 first strike output and 313. So again, you're going to be right at the $6 level. So it's right around 14 total dollars for the straddle strangle market, $7 being priced in as far as a move between now and April expiration. Pretty impressive move being priced in, even though implied volatility is low. So with that forecast, you could see the stock as high as 147 or as low as 133. Now, we don't want it to go much beyond 137, and we definitely don't want it to happen fast. And I don't think this is going to happen quickly because there is a lot of enthusiasm with this market. But if the market were to pull back and start to, over the next, let's say 20 days, gravitate towards the 137 level after an impressive pop to the upside, that means that I have profit potential on this spread at 137 of about $230 per contract. Okay? What's my risk? It's the difference between what I'm paying for the 142s minus what I am selling the 137s. Okay? So if I can do this, and let's see if I can get this thing done. Let me just decrease my font a little bit so I can see the pricing. Let's say I pay $630 and I sell it at $220. That's going to get me in at around $410. So I can put in a debit price of $4.10. That means for every contract that I do, I'm risking $410. Now, if I have a $25,000 account, I want to stay roughly around 5% of the total account value in any one position. I'm going to do 2 contracts. So I put 2 contracts in, day order only. I review the order. So what am I doing? I'm buying, and I apologize, it logged me out. Let's see, I'm going to go trade, options. And I'm going to jump in here and I am going to do IWM. And I'm going to do create my own because then I scroll down and I just click on what I want to buy and what I want to sell. So I am going to buy the Junes. And remember, why am I buying the Junes? I want to give myself time to be right. So I'm buying the Junes. So I click once and I am selling the Aprils, which expire in 51 days. So that means I'm willing to pay $630, right around there, sell them at around $220. I'm going to do 2 contracts, which would be basically about, well, exactly $820, not including commissions. So if I'm doing $410, that basically is right around the 5% level. And I click review order. And again, I'm doing a debit, which means I'm paying. That means that that's my maximum risk, $4.10 or $410 per contract, $810. Click place trade, and now I'm going to work it. You can see it's 407 at 412. I can actually go in and change it. Let's just say, for example, I do want to get filled just so that I can get into the trade. I'll put it in at a 412 limit and place the order. So that basically should get me filled, and it keeps moving on me. All right, well, folks, you get the point. Is basically if, in fact, IWM starts to gravitate towards 137 between now and April expiration, in other words, over the next 51 days, I have the potential to make a profit of right around $230 per contract, not including any type of commissions, which here are really inexpensive, and the industry is extremely competitive. So you can take a look at that and always inquire with me directly. So we placed that order, and we'll see if I get filled. Once I am filled, then basically what will happen is I will then manage it through my positions, and the side of the trade that I'm going to be managing is going to be the short side. This is the call debits diagonal spread that we did in Goldman Sachs earlier this week. You can go back to Strategy Now and take a look at that. That's where we were bullish on Goldman Sachs after it had made a move post earnings and financials were starting to make a move. And you can see that we bought the bought the 235 calls that are in the money. We sold the 260 calls that are out of the money. You can see that Goldman Sachs continued to move to the upside. So the 260 calls we sold are not working for us, but the 235 calls that we bought are, and we're showing a small profit. We initiated this on the 24th. So that's how these diagonal spreads, we're using the longer term, deeper in the money option as a proxy for stock against what our bias or opinion is. And in this case, we were bullish, and we were using the short option to pay or offset the purchase price of this proxy. And if the market goes up and grinds up or moves up, and as it gets closer to that short strike price, we're going to start recognizing a total profit. And we only have to use a small fraction of what it would cost to actually position in a bullish position if we were just going to trade the stock outright. Okay, folks, that's it for Strategy Now, right? And we're going to be back at 3:30 Eastern Time doing a little tech talk. So we'll see you then here at MarketStream.live.